Hey guys, welcome to another live broadcast. I'm excited to be here tonight. I've got some family coming in, and so I did the stream a little bit early tonight. They'll be here probably about 8 o'clock, but if they get here a little early, I might have to drop off sooner, but we'll see. We'll kick this can around until I have to go. How does that sound? So I just wanted to show you guys the shirt. It says Beekeeper. What you can't see is beneath it says, if I run, you run. Yeah, so there you go. You got that going for you. So tonight, I think we're going to have a pretty good show, a pretty good broadcast. We're going to talk about something I actually learned in grad school, and I wanted to, it came across my mind today, and I thought, I'm going to share this on the live stream tonight. And it's about asking the right questions. So I'll get into that here a little bit more. And then I'm going to share, something else about the portfolio. And as always, we're going to kind of look and see how the portfolio is doing. And then probably kick around, some of my buys for the week and stuff like that. So hope that is enticing for you guys. And I have my iced tea tonight, so I will be refreshed as we talk. So let's see who else on tonight. If you're actually watching, shoot me a little note here. And we got Dividend on the Dividend Dad in the house. X to the what, X to the who, Dividend Dad is in the house. That Kevin built. Yeah, that's right. Of course, you had a lot to do with that, encouraging me to do this. So I appreciate that. And we got Shannon. Shannon's on the broadcast. Good evening to you, my friend. We got Pat. Pat hit an all-time high today. That's fantastic, man. Good job. Congratulations. Steve C is on the broadcast, and he picked up Pepsi at 129.60 today. Man, can you believe that? I was, the last time I really played around with Pepsi at all, it was like in the 170s. So, man, it's really taken a beating. So, yeah, let's see. Kevin, I watched that live stream last week. Great job. I came this week for the honey giveaway. If preferences matter, I'd prefer 5'6", 134 pounds, and 33 years old. So, maybe I should call your wife and find out if those are her measurements. Oh, man. Yeah, I don't know, man. I think you're going to get us both in trouble with that. So, probably better rock with that. All right, so for now, let's go ahead and get started. I'm going to actually share the screen, which I forgot to do before the broadcast. Imagine that. All right, so let's that's too big. There we go. That'll be all right. So we're going to talk about asking the right questions. So when I was in grad school, one of the assignments we had was to come up with the right answer for a particular problem. And I won't go through the problem. I'm not even sure I could remember it all. But, we had to come up with the right answer. And we struggled with that. We, came up with different formulas. We just tried to come up with the right answer. And we came up with what we believed was the right answer. And so we came to present that. And the professor said, well, what is the question? And so we were sitting there, and we had really been focused on the answer the whole time, and had not really spent a lot of time thinking about what was the right question to ask. And maybe the answer we were coming up with had nothing to do with the right question. So it's kind of made me think about that really in everything that I do, and especially here in the portfolio. So as you know, I've built this little spreadsheet, and what I believe is that I'm asking the right questions in that portfolio tool, and it's coming up with, I think, some pretty cool results. So far it's been doing pretty well. But here's some examples for you, and maybe just take these down, and if they fit you, then that's great. If they don't, then it didn't cost you anything but a little bit of time. So all right, let's go. Wrong question. What is the dividend yield? What do you think the right question is? Right question is, well, and before I go to the right question, I hear, on YouTube videos, there's some that will say, I don't know, I'm not going to say that it's widespread, but there are some that would say, my portfolio yield is X%, 5%, let's say. And so people then try to chase that dividend yield, try to get their portfolios up to a dividend yield of 5%. What's the real question, though? What's the right question we should be asking? And that right question is, what's the total return? And I want to share something with you guys. Since there's only a few of us here, I'm going to go over to here and show you. So in my tool, in my spreadsheet, I track every investment I've made since I retired in April of 2021. So here's the sheet that actually tracks that. And as you can see here, the total return for what would this be? Right at 4 years. Wow, 4 years has been about $480,000. So if you think about that, that's right at $120,000 a year the portfolio has made. And I knew I was going to go to this sheet, but I hadn't really thought about that number. That's a pretty big number. So I'm happy about that. But if you look at this, you can see that the dividends, interest, and options, that would be, if I got a dividend from a company, if I got interest from the money market while my cash is sitting idle, or if I, purchased an option, the premium of that option is what I would put in here. So really, this is kind of like income, but it's really dividends, interest, and options. I can tell you the options piece of that's very small. The interest piece is also, relatively small. So dividends is the majority of it. I've gotten over the last 4 years about 120, almost 127,000 in dividends. But if you take a look, the realized and unrealized gains is about $350,000. That, all this together, is the total return. The wrong question, I think, in my opinion, and that's all this is opinion, is the wrong question is, what is the dividend yield? What income am I going to get from that stock? Typically, if the income is high, the stock price is low, and there must be some reason for that. There's got to be a reason that investors are pushing the stock price so low that the yield is high. And it's okay to have a high yielding stock as long as we understand why it's being priced that way. So I think a better question, the right question is, what is the total return? Hey, another wrong question is, how much dividend income did I get? And I think I pointed this out in that other slide. Maybe the right question is, how much dividend income do I need? I don't know that it's right for us as investors to try to maximize our dividend income. I do invest in dividend paying stocks. I invest only in dividend paying companies, but I don't try to target the most amount of dividend income I can get. I know how much dividend income I need, and I put the investments in place to get that. So I'm not chasing the amount of dividend income that I get. So the next wrong question is my portfolio beating the S&P 500? And so that's something that we tend to ask ourselves: is my portfolio beating the S&P 500? The right question is, what should my portfolio benchmark be? Is it the S&P 500? If you're younger, that's probably a very good thing to use. If you're like me and you're retired, it may not be the S&P 500 that you're looking to benchmark against. So the right question is, what should I benchmark against? The wrong question is, did the portfolio beat the benchmark today? The right question is, has the portfolio outperformed the benchmark over the long term? So I thought I'd share a few little slides with you. This is kind of fun for me. So you guys have seen this before. It is the year-to-date performance of my portfolio, the Wealth Circuit Investing portfolio, the S&P 500, the NASDAQ, the Dow Jones, and the Russell 2000. So these points on this graph are the year-to-date returns as of those particular dates. So this is year-to-date. It's all the way through June the 6th. I know it says June the 3rd on there, but it's just it does go all the way to June the 6th. So you can see that the portfolio is in the green. And there were times early in the year that I was probably like in the middle of the pack, almost at the bottom of the pack here. And then all of a sudden things changed. And so now we're leading the pack. We're leading all of those metrics. But, that's all well and good. I don't get excited or decide to change my strategy, though, if I am trailing the pack. Why is that? Because I'm looking at the long term. And if you look at this is actually starting on, let's say, January 1st of 22, December 31st of 21. That was the point that I really had all of my investments in the brokerage account ready to go. And so it's just a great time to start the benchmark for the portfolio. And as you can see, the Wealth Circuit portfolio has outperformed over the long term the S&P 500. But again, is the S&P 500 what I'm tracking? And the answer to that is no. I'm really tracking what I believe my benchmark should be, which is an 8% return per year. So far, since 12/31 of 21, the annual return has been 9.1%. So I'm pretty happy about that. I'm going to continue to try to fine tune and hone my investing strategy. But overall, I'm pretty pleased with that. So I guess the point of this is, don't get sucked into just doing what everybody else does. Think about your portfolio. Think about your current situation. Think about your family situation, and decide for yourself what it is you want your benchmark to be for your portfolio. If it's the S&P 500, that's great, and then compare against that over the long term. If it's something else, compare against that. So I do the S&P 500 as well, because I know it's real popular here in the investing world. So, but I don't get too bent out of shape one way or the other if it's not doing well. So hey, here's a question for you. For those of you who have been paying attention in the Discord, and if you're not a member of the Discord, you can click the link in the notes to this video and join for free. I like to see a lot of the discussions that go on in there. But for those of you who have been paying attention, I added a new stock to the portfolio. So anybody remember what that stock is? I don't see any guesses. I posted it out in the Discord when I bought it. And there was actually a discussion, but I know that the gentleman who asked the question about it is 7 hours away. So I know he's asleep right now. But yes, we got it. It is, as ex-dividend dad says, NOC, Northrop Grumman. So here is my new stock that I've added this week, and it is Northrop Grumman. It's brand new to the portfolio. I now have 25 holdings. probably be looking to get rid of 1 or 2 holdings just because 25 is the max that I want in the portfolio. But anyway, Northrop Grumman has a pretty diverse defense budget. So they go air, cyber, land, sea, space, multi-domain, whatever that is. AI, advanced weaponry. So they've got a lot going on. Also, they break into 4 segments, and they are pretty much, I guess the strategic missiles and stuff is a little bit lower, but they have 3 that are very close to each other. They're very balanced in their revenue stream. So I really like Northrop Grumman. The price for Northrop Grumman, I think, is attractive at this point. So here, let's take a look at this. You don't want to see that anymore. Let's do the buys. You can see Northrop Grumman right here. It is now 1.53% of the portfolio. So as you know, I don't buy anything. I don't buy any new stocks for the portfolio unless I'm willing to invest at least 1% of the portfolio in that stock. And Northrop Grumman, I think, is at a place where I am comfortable with that. They have a wide moat. They are 21% below Morningstar's fair value. They have a relatively decent return on invested capital. I think part of that is related to part of why it's not higher is that they wrote off some things in this last earnings season. Let's see. Dividend safety is 90. They have relatively low dividend yield, but again, that's not the right question, right? The right question is what's the total return? They have buyback yield of 2.6%, so total shareholder yield of 4.4%. And the analysts believe it's that they're going to return a total return of about 12%. I think it's going to be more like 18. So I like Northrop Grumman, and so I bought some. So there you go. We got that. Let's see what else we got here. I think that's it. That was it. So back to the program. So yeah, NOC. Yeah, so in NOC just had a higher low, I guess a better low not too long ago. Yeah, so I think I'm bullish as well. Yeah, Russ says NOC reminds him of APH. I think that's right. I think any of these defense stocks, and I own several of them, I probably have created my own ETF for defense stocks. I think the only major defense company that I don't own is maybe Huntington Ingalls, but all the others I own: Lockheed Martin, General Dynamics, RTX, and now NOC or Northrop Grumman. So I've got at least 4 of the large defense companies, and I'm good with that diversification. I think that works for me anyway. So yeah, I think it's I think because of they've got a wide mix of things that they do. They got a huge backlog, like $90 billion of backlog. So I think they're looking good. Yeah, that's right. The Rust is saying that the NOC's most recent quarter's net income was down 50% year over year. Was that a one-time thing? Yes, it was a one-time thing. Sales fell. So, yeah, they had to write off. I don't remember exactly what it was, but there was a write-off. I think it was related to maybe the B-21. There were some costs that they had to write off for that. But that was a one-time event. And but it did cause some struggle for investors, and I think that's what we're seeing now. And I think over the long term, it'll be fine. You know, it was something similar, some situation similar to this several years ago when I picked up Lockheed Martin, and so Lockheed Martin is going to cheat here and look at Lockheed Martin. If I can find it. Oh, I don't want to look at it there. I want to look at it here. Lockheed Martin. So the current sell price, and it's come down a lot, is $480. My buy price is $351. So I'm cool with that, and I'm letting that ride. It is just gonna ride me into the sunset, as they say, or I would guess I would ride into the sunset on Lockheed Martin. But anyway, yeah, that's it. All right. Yeah, I could, Steve. I could get a defense company ETF, but what's the fun in that? I do that actually for chip companies, the semiconductors. I use SOXX, and I've been very happy with that. It keeps me from having to invest in individual companies, not just invest in them, but having to research them and understanding what they bring to the table. I like the defense companies, so I just decided to invest in those directly instead of getting an ETF. All right, let's see here. What's happening? John Jay, he's late again. Well, actually, I'm early, if that helps. I'm early. So do you see the legacy defense contractor not being the innovator that they used to be versus Elon Musk company? Yeah, I think there's something to that. I think, we're going into this era of AI. We're also going to an era of, space, Star Wars, and so is there going to be a major shift in what these companies' capabilities are versus what a new up and coming fresh company would have? Probably so. But I think there's room, right? I think there's room for that. I don't think that we will get away anytime soon from having the what was it called, the Sikorsky helicopter, from having the F-35s from Lockheed Martin, having the tanks that General Dynamics produces, having the B-21s from Northrop Grumman. I don't think so. Will it at some point change that? Yes. I don't know if it'll be in my lifetime, but I do think there's room for that to grow, and it'll be fun to watch that. But I'm not at this point jettisoning my defense stuff, because I think at some point a company might have some more be a better innovator than the ones that are now. And I do think that it does. Having innovators in your space breeds innovation. So I think that these companies will respond. I just don't know which ones will respond better. So, SCHD Stan, welcome to the program, man. It's good to see you. This is like 2 weeks in a row. What's up with that? Yes, I bought. Okay, he bought Lockheed Martin around 20. That's when I got it too. I think for around that price too. Yeah, that is when I bought it. Hey, remember, my little spreadsheet here would tell me when I bought. So if you guys will give me just 1 second, I will limit this down to just Lockheed Martin and just look at my open positions. And my first purchase was in September of 21. Yep, that's when it was. September, October, December, January of 22, March 22. So I bought several. Actually, it was drip at that point. So I think the main buys were in October and January. I did buy more of that. Here, let me pull up the closed transactions as well. Oh, yeah, there's a lot. So I bought, they got dividends in there too. Let me just do where I bought shares. So I bought that 6 times, actually. And I bought it in August of 21. I bought 2 tranches in August of 21, 2 tranches in October of 21, 1 tranche in November, and 1 tranche in January of 22. And that's the only time that I bought Lockheed Martin. I sold some of those off because I had gotten it up to, my rule, right? My rule is I can take an individual investment up to 5% of the portfolio, but if it's not going to be some kind of extraordinary gains in the future, at least from my perspective, then I can back that back down to about 2.5%, and that's what I did with Lockheed Martin. So it's a lot of fun, isn't it? All right, good deal. Yeah, I think I caught your point on that, I think. Can you look at insider activity at Northrop Grumman? Actually, I can. And since you asked so nicely, I'll do that. So here we go. Northrop Grumman insider. Let me see if I can find it. I'm going to find it before I switch it on the screen here, just so that it's not too boring for you guys. Oh, hold on. Never mind. I was looking at the whole portfolio going, why can't I find insider trading? Yeah, I'm going to go ahead and switch over. I'll hide that. So recent insider trading, we had Kathy Warden sold on March 5th. Who is she? Oh, she's the chair, CEO, president, and director. I like what my buddy Russ says, though. And that is, and also in February, Michael Hardesty sold about 875,000. He's the controller. So that's the recent activity, I guess, back through at least February. This is the hedge fund activity, but I don't pay attention to that. But 0.22 is insider, almost 29% is mutual funds. 32% is public companies and individual investors. So I was going to mention, what my buddy Russ says, I really like what he says about this. He says there are many reasons that people sell stock, that sell parts of companies. And I do that, right? So when I was investing in this honey business, I sold some stocks to pay for that. When I was giving money away at the end of 2024, I sold stocks to donate those funds. And so there's lots of reasons that we sell stocks, but there's really only one reason that we buy, and that's because we think it's a good investment. So just because insiders are selling does not mean that we can't really infer from that they're selling for any particular reason. Let's see. Oh, Michael Swami's in the house. Let me get rid of this other stuff here. Michael's in the house. Good to see you, buddy. So you were early. You bought in April. I don't know. Yeah, I don't know if you were early, but you were right in there with us, man. So that's good stuff. Yeah, it was good. And and so I think Northrop Grumman is kind of in a similar spot here. It's not as dramatic as Lockheed Martin was at that time, but I think it's in a similar spot. And so therefore I feel good about adding it to the portfolio. We will see. I'm not trying to convince anybody to add it to their portfolio. I'm just saying that that's what I added to mine, and we'll see how it does. So all right, so Rust bought 3 T-Mobile today. And there was some discussion, I think, in the Discord about T-Mobile. T-Mobile's been blowing it out of the water. I mean, compared to Verizon and AT&T, they've been really killing it. So I can't say that's a bad thing. So, all right. So what do you guys want to talk about today? I've exhausted my things that I wanted to share with you. So what do you guys want to look at? Do you want to look at any particular stocks? What I can do is go through the buy stocks that I have. And what will be interesting is that it is no different than it was last week. I have 5 buy stocks. I have ConocoPhillips. That seems to be the biggest potential gainer. I have Google. I have Hess Midstream and Carlisle, CSL. And I have Northrop Grumman. So those are the 5. And, one of the things I may do, I've got a stock that Wisconsin Electric. It's about the only utility that I still own outright, meaning not inside an ETF. And so I may unload that and put a little more into Carlisle and Northrop Grumman. And maybe a little bit into ConocoPhillips as well. Go ahead and get these up to that, at least that 2.5% that I like to have them at, rather than having them sit there, especially since they're on my buy list. Why not go ahead and get them at least to a normal weight in the portfolio? So I may do that. Don't be surprised if you see that happen. Not sure if it'll be this week. I think we got a lot going on this week with our visitors here. We're leaving for out of town on Thursday. So anyway, we'll I'll be back soon. It's not that I'm going for a long time. It's just that it's just going to be busy. So I'm not sure by the end of this week if that'll happen, but it may work. All right, Flow. Now, I don't think I track Flow in my sheet, so we'll take a look at it in Simply Safe Dividends. But it reminds me of, there was an old show. How many of you remember this? There was an old show called Mel's Diner. There was a waitress. Her name was Flo, and her iconic saying was, "Kiss my grits." So how many of you remember Flo? Anyway, of course, the Flo most of you guys will know is the Flo off of the Progressive Insurance commercials, but that's not the first thing that comes to my mind when I think of Flo. All right, here we go. Flow. And also there's a honey flow. That's when nectar is prevalent and bees are bringing the nectar into the hive. That's called the flow. So all kinds of different flows, but this is not a flow like that. It is Flowers Foods. They've got a 60 borderline safe dividend. They've got about almost 6% yield. Triple B credit rating. So that's, that's pretty decent. Let's see. Wow, they were founded in 1919. That's been a long time. They're over 100 years old. Yeah, they downgraded from 62 to 60. I'm not sure why they would do that. I guess they moved from safe to borderline safe, but that's only 2 points. I don't know. I don't get it. But payout ratio is 76%. The dividend growth is very steady. Look at this chart. It is just growing every year. It is growing at a much slower pace. You can see the last one's 3.1% versus a 5-year 4.8 and a 10-year 7.0. But they have a 22-year streak. So that's good. Let's see let's check out the financial data here. The earnings payout ratio, wow, jumps up to 90%. Yeah, I don't follow them, so I'm not really sure what's causing that, but it might be worth looking into. If it's a short-term thing, it's not a big deal, but yeah, But it's really interesting. Their cash flow is not impacted by the same thing. Take a look at that. That's pretty interesting. Earnings are dropping. Return on invested capital is dropping. It's down around 8%. Net debt to capital is about 60%. Their interest coverage ratio is, right at the borderline. It's 8.38. So, it doesn't really excite me. Why is my thing moving so slow? Yeah, Flow doesn't excite me a whole lot. Maybe it's cheap. Let's see what the chart looks like. And again, I don't follow it, so let's look at a year to date. Yeah, it's dropping. It's down 16.5% year to date. Let's see, over the last year, it's 26%. It's down over the 3-year period. It's also down over the 5-year period. So, yeah, it doesn't excite me a lot. I don't know enough about the business to comment on their strategy or whether I think it's, it can be short term, but because it just keeps dropping. And even the 3-year. Yeah, I don't know. That doesn't look too exciting to me. Is there anything about it that I'm missing, John? I don't know. CRM and MPWR. Yes, I can pull those up. Let's take a look at those two. CRM, I think that's Salesforce. Yeah. So Salesforce has a 80 dividend safety score, so that's pretty good. They've got a very small dividend yield of 0.61, A+ credit rating, so that's good. Very small payout ratio. Earnings are growing like crazy. Shares are kind of flattening out, so that's good. Sales are growing. Return on invested capital is finally up to about 9%. Looks like they don't have any net debt, so they do have some debt, and their interest coverage ratio is 26, so there's no issues there. So, yeah, I don't see any issues with Salesforce at all. Looks like it's a growing company. And, I don't see any issues with the CRM. Let's look up MPWR. I should know what that is. No, I shouldn't. Why would I know that? Monolithic Power Systems. Monolithic is borderline safe at 60, dividend yield 0.88. Man, their dividend growth is crazy. Let's take a look at that. Look at that. It's growing like a weed. 25% this year, 25.6, 27.2 over the last 10 years. Man, that's incredible. Let's take a look at some of the financials. The earnings payout ratio looks very decent in the mid-30s. Earnings per share is growing. Free cash flow per share is taking a bit of a hit. I'd want to understand that. But it's still very positive. It's not terrible. Sales are growing like crazy. Return on invested capital is somewhere around the 15%. I'll take this opportunity to share something with you. So let me grow this a little bit. Look, some people will look at return on equity and go, wow, that really jumped up. So return on equity can really be deceiving. And if a company buys a lot of shares back, let's see what they did. See if they did that. No, they didn't. I'm not sure what happened, but Monolithic Power Systems has grown their return on equity quite a bit without growing their earnings per share significantly. So, I mean, it's grown some, but not to go from 23% to 69% in return on equity. But look at their return on invested capital. That's about, it's staying pretty even. It's in the mid-teens, which is a fine return on invested capital. But sometimes entries can get made. Give an example. If a company buys back a lot of shares, they will pay that in cash, right? They will buy those shares with cash. They credit cash. Guess where the debit goes? The debit goes to equity. So if they buy back a lot of shares, it drops their equity value down and keeps their debt where it was. But so if their equity and debt are here, and all of a sudden they buy back some shares, their equity drops a lot, and their return on equity looks much better. But that's why I always look at return on invested capital, because it doesn't matter whether that capital has been invested through equity or debt. It is capital that needs to get a return. That's why I like return on invested capital. So, but anyway, return on invested capital looks fine. Looks like they don't have much debt at all, and maybe none. Looks like they don't have any. So, it's it looks intriguing. It's an information systems semiconductor company. Yeah, I may spend a little time on that ex-dividend dad. Gave me something to do, man. I'm going to add this. I'm going to create a list in here. Where am I going to put it? I'll put it right here. MPWR. All right. So I'll look into that a little bit more. That's a good call. Yeah, I think so too. CSL, Carlisle is a good candidate. I think they are good. All right. What are, if we talk, I'd probably not much. So what are your thoughts? So XOM, that's Exxon. HES, is that Hess? Do you mean Hess Petroleum, HESS? All right, let me just look it up, see if there's a HES. Just for fun. HES. Maybe there is an HES. Oops. Yeah, I think you mean Hess Petroleum. So what do you think about the cyclical nature of the sector? Yeah, I think that's something we got to be careful about. So first of all, I think Exxon is fine. And Hess is currently in the throes of passion with Chevron. So looks like Chevron's going to take Hess over. So I typically don't buy companies who are about to be taken over. I don't like to play the arbitrage thing where maybe they're trading a little bit less than what the company's willing to pay, but things could happen, right? And it could even fall through. And so anyway, I don't play that. So I end up saying I'm not interested in Hess. But Exxon looks good. I like Exxon. I like Chevron. But the one who, let me see, I may even track. Before I pull it up, let me see. Dun, dun, dun. See if I track Exxon. I do. Let me pull this up. Here we go. Here's Exxon. It's on my watch list. I don't own any of it. I have it as a hold. I think it's going to have a total potential return of 13%. We've got the analysts are saying 23%. It's got a narrow moat. It's about a 22% discount. Return on invested capital is about 12%. Dividend safety is 80. So, things are looking good. I think it's a very fine investment. I think now if I were to go in here and pull up See if I can get just these two. ConocoPhillips. All right, so to compare ConocoPhillips and Exxon, I own ConocoPhillips. I think they have a potential for 24% return versus a 13% for return for Exxon. Analysts also think that there's roughly a 9% higher return over a 1 year period. They both have the same moat. They're both roughly valued about the same at, Conoco's 21% fair, less than fair value. Exxon is like 22%. They both have return on invested capital, 12% for Exxon, 13% for ConocoPhillips. Now, ConocoPhillips has a dividend safety rating that is much lower. I don't think that's fair based on this latest acquisition of Marathon, but it is what it is. They both have roughly the same shareholder dividend yield. So, what's not to like about ConocoPhillips? I think that there's a better return potential with ConocoPhillips than there is with Exxon. Although I will say Exxon's a fine investment. If somebody wanted to buy Exxon for whatever reason, that would not, hurt my feelings at all. So yeah, I like Exxon. I just think ConocoPhillips is better. They are definitely cyclical. All of these petroleum companies are cyclical. I tend to try to buy them on the down cycle, and I don't really go like full bore into them. As you notice, I got 2.2% of ConocoPhillips, and I think that's the only petroleum company that I own. So I used to own Chevron. I don't know if I own any Chevron at this point or not. It's pretty bad when I don't know what I own. Yeah, see, I don't own any Chevron. That's the only gas and oil company that I own. Hey, David, good to see you, man. He remembers Flow. So that was a good show back in the day. It's good stuff. Oh, yeah, it was called Alice. You're right. Michael's always like correcting me and making me look really silly on here, but that's okay because I am. That it was called Alice. That's right, Alice, and I thought of her immediately along with the progressive lady. There you go. Yeah, Mel's Diner was where they worked, and I don't remember much more about it. I know that Mel owned the diner, and he was a rough, gruff guy. And then Alice was a single mom, had one son. I don't really remember like totally enjoying the show, but Flo was incredibly funny, I thought. So that's why it comes up. Yeah, so John Jay's saying Ozempic is affecting Pepsi, Flow, and other similar stocks performance, possibly. Yeah, I'm not sure. Maybe. We'll just have to see. I think you're right. I think it is affecting it. Is it affecting it more than it should? I don't know. It's there's a lot to be said for, all these processed foods that we have here in the U.S. So we'll see. Yeah, Hess Corp. Good deal. Good. Yeah, I think HESS is Hess. I could be wrong, but I've been wrong before, and I'll be wrong again. So just remember that when I say stuff. Let's see, Exxon and Hess and the two U.S. oil companies that have access to the massive oil discovery in Guyana. Oh, I haven't heard about that. I have a special interest because my dad is from there. Gotcha. No, that's great. I have not heard of the massive oil discovery, so that could change things. But unless I've missed something, Chevron is going to get that. So maybe it's maybe Chevron's the play. So Yeah, no, that's good. So maybe those are good plays, and I think when I think about that, if it is such a huge discovery, then what does that mean for the rest of the market, the rest of the sector? And sounds like oil prices are going to continue to drop, maybe with more supply on hand. So maybe it's not time to buy ConocoPhillips or any of them for that matter. I don't know. Oh yeah, it's big in SCHD. Yeah, they got a good one. I think that's a real good play. Then the two broke girls that took over the diner. Maybe is that I don't know if those are related, but that is kind of funny because that they could be. It looks similar. Could be the same diner. I don't know. Okay, good. That's interesting to know. I didn't know this. Exxon and Hess are the two only two companies have access to Guyana. Yeah. Well, good deal. No, I think it'll be fun to watch that, and let's see what it does to the sector. Um, if it drives the sector, if it drives prices down, it could actually have a negative impact on the sector, although a positive possibly for Exxon and Hess. I don't know. Oh no, I was just teasing with you, Michael. No, I appreciate you, man. It's sometimes things are in my head the wrong way, especially when they're that old. And I appreciate you bringing those out. I was just messing around with you, man. I don't don't feel bad about that at all. I like it when somebody corrects me because I don't want to tell you guys something incorrect, even though who cares, right? Who cares whether it was Alice or Mel's Diner? At the end of the day, it doesn't matter. But I don't want you to have the wrong data. So, Michael, keep doing it, man. You are the man. Oh, Kenji has arrived. It's a good job. So yeah, Chevron is buying Hess for 170, but it's trading at 134. Yeah. So that's what I mean about arbitrage. Is there's a reason that it's trading for 134, and I'm not keeping up with the Chevron and Hess deal. I do own Hess Midstream, but that is a separate company now from Hess. So I really haven't kept up with it. But if investors are not pushing that toward the $170 price, there's got to be some sense that it's not gonna to close at that price. Otherwise, investors will run it up to that 170. It could be 165, but they'll run it up to that price unless there's something that is causing them concern. So I would look at it from that perspective. I would want to know more about that Chevron Hess deal before buying Hess over Chevron. So, or maybe if you want Hess, if you want the deal not to go through because of this Guyana thing, maybe that's the play. But there's a lot of research. I guess the point is there's a lot of research that needs to be done on that, and I have not done any on those companies on that transaction. So I've not done any on Exxon or Hess, and those are the two that have access to Guyana. So. All right. Well, we're at 7:55 already. Can you guys believe that? Is there any news that we want to talk about today? Let's see. We may just kind of wrap it up going through the news, latest. I was not able to catch Russ's show last night, so I'm not sure if he caught that. Yeah, before we do. I saw that, Rust. Let me get back over here. Yeah, the riots burned several of Google's Waymos, but I'm hoping those are insured, right? So we'll see. But yeah, that's kind of nasty, man. That's I don't know. It's like people don't have a life, you know. I don't think I would want to participate in that because I enjoy bees and chickens and stuff more than I do fighting over sending people who have committed crimes back to their country. So antitrust, yeah, that could be that they have not gotten the approvals from Department of Justice and all of those places. Any place they need a regulatory approval could be something like that. I'm just not sure. Okay, so let's take a look. We've got TU, Telecom Services. They refreshed their outlook on it. It's a 60 dividend safety score, about a 7.3% dividend yield. FedEx, believe it or not, raised their payout by 5.1%, 23 years of interrupted dividends. Yeah, 2.6% yield, so that's good to know. PK, whoever that is, Park Hotels, cyclical risk, they dropped them from borderline 50 to an unsafe 40. So if you have Park Hotels, it's a lodging REIT that was spun off from Hilton in 2017. So you may want to take a look at that. Bristol Myers, they reaffirmed Bristol Myers. Oh, I've gotten, no, that's okay. Yeah, as you guys know, United Health increased its dividend by 5.2%. I posted that out in the Discord. Let's see what's, they refreshed their outlook on Southern Company. Looks like they didn't change anything. So it's 65 AES. I think that's out of Missouri. One of the nation's largest renewable energy corporations. Like, yeah, wow, that's a 49, borderline safe. All right, that gets us way back there. So, yeah, that's all the news that's going on, guys. So, with that, I think I'm going to go ahead and let's see, catch up here. Yeah, it's good to see you, SCHD Stan. I appreciate you, man. I'll see you on the next one. And yeah, that's right. See you in the Discord. If you're not in the Discord, consider joining it. It's free, and we like to talk about stocks in there. So, and I'll typically say what's going on in my portfolio as I do it. So, with that, guys, I'm going to get off of here. Get ready for our guests that are coming in. I hope you enjoyed the stream. I did, and I will see you on the next one.